Hello everyone, welcome back to the channel. Here is a quick question for you. Have you ever noticed that the same amount of money that used to fill your entire grocery bag 10 years ago now barely covers half of it? That feeling has a name for you. It is called inflation, and its dangerous cousin, deflation. Today, we are going to break down exactly what inflation and deflation are using real-life examples from India and around the world. We will also reveal how the Reserve Bank of India, the RBI, and of course, we will cover all the advantages and disadvantages of both. Stay till the end. This is going to be super clear and genuinely useful. Let us start with inflation. In simple terms, inflation means the general rise in the prices of goods and services over a period of time. Think of it this way. In 2010, a plate of dosa at a restaurant in Bengaluru cost around 20 rupees. Today, that same plate can cost anywhere between 60 to 80 rupees. The dosa did not get 3 times better. The purchasing power of money simply went down. That is inflation at work. Officially, inflation in India is measured using 2 main indexes. CPI, Consumer Price Index, tracks prices of everyday items like food, clothing, fuel, and transport. WPI, Wholesale Price Index, tracks prices at the wholesale and producer level before goods reach consumers. The RBI mainly uses the CPI to monitor inflation. Its official target is to keep inflation at 4% within a tolerance band of 2% to 6%. Now, deflation sounds like a good thing, right? Prices falling sounds like one big permanent sale. But trust me, deflation is actually one of the most dangerous conditions an economy can face. Now, deflation means a sustained and general fall. Prices falling sounds like one delays purchase. As everyone delays purchases, business profits leads to jobs and unemployment. This happened during the Great Depression. The stock market crashed, people lost their jobs and stood in long lines. Banks closed, taking people's savings with them. It was a very difficult time. Now, what causes inflation? First, there's demand-pull inflation. This happens when demand for goods surges, leaving stores crowded and prices rising, push inflation. On the flip side, deflation. Typically, it's a big drop in demand. When stores stay empty, businesses are forced to prices to attract customers, and prices fall even further. In India, the Reserve Bank of India, or RBI, controls inflation. It has a dedicated monetary policy committee that meets regularly to maintain economic stability. Reverse repo rate is the exact opposite. The RBI uses this to absorb excess money from banks, which effectively decreases liquidity in the market. Is the cash reserve ratio. Commercial banks must keep a specific percentage of their total deposits with the RBI as reserve funds. This shrinks their lending capacity. SLR ratio. Commercial banks requires banks to maintain a certain amount of deposits in the form of liquid and treasury bills. This also helps in reducing bank lending. Finally, we have open market operations, or OMO. This involves the RBI buying or selling government securities in the open market. This process regulates the amount of money entering and leaving the economy. We also have MSF and bank rate. These are rates at which RBI lends money to commercial banks. MSF acts as an emergency lending window for banks, while bank rate is for long-term lending. Inflation can boost economic growth. It encourages businesses to invest and expand. Entrepreneurs and farmers can benefit. It also leads to an increase in government tax revenue. Inflation reduces purchasing power. It erodes the real value of savings. High inflation creates economic uncertainty. It can worsen income and wealth inequality. Think of Sri Lanka in 2022. It faced its worst economic crisis, with inflation soaring over 50%. This caused severe economic hardship. Deflation can increase purchasing power. Pensioners and savers benefit from lower prices. It can make exports more competitive. Deflation can lead to businesses closing. It causes widespread layoffs and job losses. As prices fall, spending also decreases, fueling a continuous economic slowdown. Here is a quick summary comparing inflation and deflation. As we have seen, both have distinct effects on our economy. And there you have it, inflation, deflation, and the Reserve Bank of India's powerful toolkit, all explained in a simple and practical way. The most important lesson from today's video is this. A moderate level of inflation is healthy for economic growth, but too much inflation can reduce your purchasing power and hurt your savings. On the other hand, deflation may seem attractive at first, but prolonged deflation can slow down spending, increase unemployment, and damage the economy. I hope this video helped you understand these important economic concepts more clearly. If you found value in this content, please hit the like button, share this video with your friends and family, and subscribe to the channel for more easy-to-understand videos on investing, personal finance, stock markets, mutual funds, economics, and wealth creation. Thank you for watching. Until the next video, keep learning, keep investing, and keep building a stronger financial future.